I think we have to recognize the fundamental driver of the Chinese economy and the fact that that has shifted very squarely away from manufacturing and towards the services economy. As emerging markets continue to mature, what we're seeing is a lot of their manufacturing is actually being targeted at domestic consumption rather than exports. And that fundamental shift in the Chinese economy is sterilizing it to some degree from the slowdown in global growth that we're seeing. You add to that the scarcity of global growth, and investors have really targeted the Chinese market this year.
That said, James, the data out of whether it's China or the rest of Asia has got worse recently. Has it been getting just a little worse or significantly worse in your eyes, and what's around the corner?
That's a great question. I think we have to look at the two-stage growth of the global economy right now. On the one hand, you have the consumer, which is spending very, very strongly. On the other hand, because in our view of significant geopolitical uncertainties, you have global business confidence at the lowest level that we've seen it since 2012. JP Morgan forecasts have global capex actually shrinking on an absolute basis this quarter. And so the impetus to the global economy from capex out of the business sector is extremely weak, partially offset by the consumer side. So that two-stage growth cycle is extremely important to the global story.
Going back to China for a minute, we've seen a lot of stimulus measures implemented over the past year or so. But if the Fed cuts rates later this month, will China do the same?
The thing to watch is really the currency. And so the two numbers that we're most focused on right now in China are 7 and 3. 3 are the foreign currency reserves. You actually saw that increase last month, which gives them some degree of wiggle room. 7, obviously, the U.S. dollar RMB exchange rate. The key risk here, particularly when you start to look at the political overlay, is that you start to see the Chinese let the yuan sterilize the impact of some of the trade policies that we're seeing coming out of the U.S. administration. If that happens, the risk is that they're seen as weaponizing the currency, driving secondary impacts and responses from the U.S., and you see this tit-for-tat strategy come into play.
James, we talked earlier a little bit about the nationalistic fervor that's now coming on because of the trade talks and the trade wars. Do you see that also reflected in a little bit of Shanghai's performance as investors are trying to get ahead of that curve a little bit if they're selling more to Chinese nationals?
I think it's more driven by the scarcity of global growth, but I wouldn't completely discount that. I think the danger that we're seeing right now from a political overlay perspective is populism and nationalism really coming to the fore across many countries around the world. The danger that creates for my area of the world in emerging markets are ultimately about trade. They're ultimately about growth differentials. And so if you start to see a deglobalization phenomenon because of populism, because of nationalism, that has significant impacts on relative outperformance of emerging markets.
What is the percentage risk of a major collapse in Chinese growth rather than just ticking down by 0.5% each year?
I think it's actually quite small. The Chinese government is almost unique in its ability to push fiscal and monetary policy in the same direction at will. And the centralized control over every element of the Chinese economy is very different than what we see in economies such as the U.S.